50 on 79th and Bishop. So 79th and Bishop's closer to Auburn, Gresham. It's gonna be west of the Dan Ryan. But yeah, I mean, South Shore too, the values were all over. I mean, the whole south and west side was high. And the reason the values, you're gonna see those markets come up and crash before you see other markets. Because it reverts back to the hard money that I was talking about earlier, right? You have a lot of hard money. You have fundyourhome.com out of Pennsylvania giving John Jones a pre-approved letter for $300,000, and they'll fund it, right? Nobody knows what they're funding, what they're backing. So people are willing to overpay because in their mind, it's monopoly money, right? I could flip this, I could turn around, I could refinance out. And people started buying on speculation in the second part of this year. And if you go back to the early 2000s, a lot of people were buying on speculation. Well, I could buy this house now. The market's appreciated so fast, I'll be able to sell it and make money. Well, the market bottomed out on them and they were stuck. Where we're at today is the rising interest rates over the last 2 to 3 months have put a halt on the market. A 1% point change in interest rate from 4 to 5% changes the buyer's power by 10%.
Repeat that again.
1% interest rate rise from 4 to 5, 5 to 6 will change a buyer's buying power by 10%. Roughly, give or take. Yeah, I mean, that's a good rule of thumb. So a guy that's pre-approved for $400,000 on an FHA loan at 4%, he's searching for his house. That rate jumps to 5%. Well, now he's approved for $360,000. That $400,000 flip you have, I hope you can rent it. Well, now the rate goes to 6%. Now he's down to $330,000. And now rates this morning, they were at 7.2. That same $400,000 buyer in July is a $300,000 buyer in November. So that's where we're at in the market right now, right?
So from your aspect, like back in 2008, when you saw a lot of foreclosures, right? I mean, there were just a lot of foreclosures because you didn't need any qualification, right? I mean, you could be picking strawberries and living in a $2 million house and have not made a payment for 3 years.
Yeah,
right?
Back then there was a lot of what they call no doc loans.
Right.
Income verification on Andrew, go to me on the loan officer. Hey man, I make $20,000 a month, and okay, you make it.
Okay.
Here's your loan. People will tell me, well, we're not going to see that problem again because lending guidelines have gotten stricter. You can get FHA loan with 540 credit score with 3% down that the seller's paying. It's not that much stricter, right? You can get a jumbo loan with 10% down and a 605 credit score. It's not that much stricter. They've changed some guidelines, but it's not that much stricter, right? I mean, so we won't see the crash that we saw. We won't see the fast crash that we saw in 08, the avalanche. What I think we're going to see is a 3 to 5 year correction. I don't think value is going to drop 20% overnight, but they're going to drop little by little over the next 3 to 5 years.
Because, I mean, if you look at the numbers, right, and anybody and there are two types of people, right? There's that one person that, this is all pessimism. And then there's the other person that basically says, that, oh my God, the whole thing is coming to a crash, right? The same people on the talking heads. Oh my God, it's never better before, buy. Now they're on the other side of it. Oh my God, it's crashing, it's over, it's worse than 2008. Might as well jump off a bridge, right? And it's never that way, right? It's never, the truth is somewhere in the middle. But Chicago is kind of a unique problem, right? And that's where the opportunity is. How is Chicago different from, let's just say, some parts of Florida? Why is it? Because Chicago is a bitch, any way you put it, right? I'm not saying necessarily bad, but if you don't know what you're doing, you're going to get your ass handed to you. So you want to kind of talk a little bit about why Chicago is so weird when it comes to the market?
Sorry. Yeah, Chicago is unique because from a few perspectives, we have the largest FHA buyer pool in the country. And why does that make a difference? So FHA loans are 200 to 450,000, I believe, with 3% down. You can't touch a single family home in San Francisco, LA, New York, or other major urban markets for $300,000. where we have a lot of that housing stock. So we're taking a lot of people who are buying affordable homes with a 540 credit score and no money down, right? Which you don't have in other markets. Well, you keep that in mind while we look at property taxes within Cook County. Property taxes are setting, I mean, you're going to see 20 to 30% increases when these bills come out. They were due out a month or 2 months ago. I guarantee you the election just happened. They'll be out in 2 weeks.
Right.
They'll come out, all of a sudden they'll be like, oh, we found them, here they are. And you're going to see 20, 30% increases in certain neighborhoods. So if you got a $6,500 tax bill, 30% increase is $1,800. That $6,500 went to $9,000 on a $300,000 house that you have no equity in, right? So we, if you look at some states such as Florida, you have a 2% set tax rate. Whatever the value is, it's 2%. We don't have that luxury because we have a horrible fiscal problem in this state. So they think they can make it up by taxing real estate. We have a large number of people leaving the state every month, every year, right? And we have we're the largest upside down market in the country. Regardless what you hear nationally that homeowners have equity, Chicago doesn't. They just don't have it because we have an FHA buyer pool that, that same guy that bought the house for $425,000 3 years ago. Some would say he got a deal. Some would say he paid high. Well, that house today might be worth $350,000, $360,000, $340,000, and his property tax go from $6,500 to $9,000. Well, how's he going to sell the house? He's upside down already, right? It's 2 years later. So that's what we have that other places don't have.
Okay. So from your perspective, right, like everybody wants a deal, especially when you come to something like this. You have a lot of people online. We're all bottom feeders when it comes to real estate, right? I mean, let's just call it a spade, right? Where do you see an opportunity, right, from your end? Because there's a misbelief that a lot of people have, oh my God, the banks are going to give houses away. What is the reality of how does this work really? How does this play out from your perspective?
Yeah, we're not going to give anything away. There's a misconception of, well, how much does the bank own it for? How much is on the books and how much was the mortgage? None of that matters. None of it. These loans have been sold 2, 3, 4, 5 times hand over hand on the secondary market before it becomes an REO. What the mortgage was, none of that matters. It's irrelevant. Fair market value is what we price the properties at. Fair market value taking into consideration of the condition of the property. As the market.
Slow down.
Yeah.
You talk too fast, right? You got to give, when you say something important, you got to give people time to absorb it, right?
Okay.
So let's just deal with this myth that, the bank owns the property and they're in it for X amount, or they're in it for 100,000. Why would they want 400,000, right? Explain the mindset behind that, because a lot of people, even today, there's seminar being done every day. Oh, we have a secret way.
So Andrew, if you own a house in Bellwood for 150,000,
right,
and the house is worth 300, are you going to sell it to me for 180?
No.
Why not?
Because I'm going to try to get fair market value for the given.
Well, you want to make money.
I want to make money.
Oh, you don't want to give it away.
No, I don't want to give
You
it
just
away.
don't want to clear off your books.
No.
Either does the bank, right? Or they've taken a loss on enough properties in their history. Fair market value is fair market value. Don't think you're going to save the day by saying, well, I can make them 20 grand and I'll get the rest. And you're not going to be their hero. And because Andrew will pay 250 for it. I mean, somebody will, right?
And fair market value, let's explain that, right? Fair market value based on the condition, right?
Based on the condition,
on the
right?
condition,
Yeah, based
right?
on. So if a 3-bedroom, 1-bath ranch in Bellwood is worth 250, right? But now ours needs a roof, or our kitchen stripped, we have mold in the basement. That value might be 175, right?
Right.
Where there's a little bit of equity in there for you to make money and turn it into rental. Our goal is not to sell properties to investors for you to make a 20% return, right? But there's enough equity in there for a homeowner to buy and build some equity, or there's enough equity for you to turn it into a rental and cash flow. I mean, that's fair market value, right?
Got it. So a lot of times, like you were giving me an example, right? You're like, hey man, there's a property coming up, possibly in Oak Brook, right? And it's going to need, how much is it going to need according to you?
Probably 400,000.
400,000, right? Because it's probably dated, it's a big ass house, it's Oak Brook, right?
It needs a lot of exterior lands. I mean, it probably needs 200 on the exterior alone, and
Okay,
another
got it.
200 interior.
Got it. So you have to kind of think about it from that perspective, that a bank is not in the business of just basically handing you deals, right? This is not how it works. You got to use common sense. But having said that, right, we have bought a lot of great deals from you, and we have all made a lot of money, right, on that, because that's where you find deals in the cracks, right? You find a lot of deals in the cracks if you're at the right place and you know the right people. And that's just what it is.
And the right place is oftentimes end of the month, like next week is the right place, right?
Right.
Because we try to close a lot of stuff in the month of November, right? Whatever we have listed or under contract, we'd like to close in the month of November. So a lot of times a deal may fall through on November, what's the date today? November 10th?
Right.
If it falls through on the 10th, I know Andrew can close in 2 weeks. Well, my first phone call is going to be to Andrew and say, hey, look, I got to still close this. This is, what I think we can sell it for. Do you want it? And I know he can close, and I'll go to my client and say, hey, this guy's bought stuff before. He'll still close this month. So that's being in the right place at the right time when he talks about that.
Right. So, okay. So basically, you're pricing the properties based on where the market is, right? Meaning, if we were having this conversation last November, the market was in a different place, right? Completely. Today, it's in a different place. Hence, the banks will adjust for that, right?
And we're starting to adjust now. We look at when we underwrite and look at diligence on deals, we're starting to adjust. All right, where are we going to be in 3 months, in a month from now, 2 months from now? Because when I price properties, I take that into consideration. Okay, this house worth 200 today. I probably won't go on the market for 3 months. Let me go at 184.9.
Right.
Let me be a little more aggressive, because at the same time, it's not a disadvantage to my clients because the market's always going to push the value of a home. When I say that is, if we list at 184.9, the demand's there, that house will sell for 205.
Right.
Because the market will push the value up, where it's harder to chase the market. Well, let's list at 214. Well, then it becomes a stagnant listing. Then we have to work our way down. We'd rather price aggressive and push the value.
Got it. Okay. So today, what are you sent me a bunch of stats, right? Actually, hold on. Before we go there, Lori, there was a question. Oh, I did. Okay. All right, good. So you send me some FCL sales numbers, and kind of walk me through this.
Sure. So we're going to talk about foreclosure sales numbers in Chicagoland area. This includes Cook, Will, DuPage, Lake, Kendall, and McHenry County from a whole, right? It's all Chicagoland market. Like I said earlier, foreclosure sales every day, Cook County holds a sale. Properties go to sale. And prior to COVID, we would see about 60% third party, which means investors such as you would buy it from the sale.
Correct.
40% REO. Prior to COVID, we were averaging about 400 REOs a month at sale, average, right? Give or take. We've slowed down a little bit. January, we saw November, December, January last year when the moratorium opened up, we saw about 400 a month. And then we saw it trickle down. So February, right around April, it started to level out at about 200 a month, April, May, June, July. But what's interesting was we were seeing 200 a month go sale, 200 a month come REO, but only 75 to 80 go third party. So that tells me more people are buying, less people are buying at the sale and waiting for it to go REO. Right. So that tells us we're going to see an influx of inventory coming up in the next 3 to 6 months, because Illinois has a redemption period or confirming sale. So from the date of sale before it hits the market, it's roughly about 3 months. So with less people buying at the sale, there's going to be more REO inventory. But then if you look at June, July, August, September, we're averaging about 200, 205. If you look at October, we bumped up to 250 when REO. So you saw a bump in October. November, so far, 10 days in, we're at 90 properties reverted REO, 10 days in. All counties, all counties. This is all counties. Well, Cook, Will, DuPage, Lake. We're not talking McHenry, we're not talking DeKalb County, right? But just the greater Chicagoland area. So we're seeing an uptick of properties going REO. We're seeing more properties go to sale. There's close to 1,000 properties going to sale between now and the end of December, right? So if you look at that and you see only 40% or so buying third party, so we're going to see close to 600 or so revert back REO, one would think, between now and the end of the year.
In terms of price range, are you seeing a difference in terms of price range as to what price range properties are you're seeing versus what you saw in the past? Condition, any of those changes?
The price is changing, or the,
No. I
the
mean,
price point's
like,
going to sale?
was it, or price points going to sale, or are there smaller properties, bigger properties? Are you seeing
No,
any of that stuff?
I mean, I think a median range for our my average sales price on REO is 225.
225, okay.
And that's probably our average sale too. I mean, you know, we see some higher end ones every once in a while. We see a lot of lower end ones, but I'd say on average, if you pulled my listings right now, my median list price is probably 225.
225, okay, got it. So as far as, let's say, a market like Berwyn, right? Great market, hugely Hispanic market generally, right? 80% or so Hispanic market, but that used to be what was a bread and butter market, right? Now suddenly for the last year and a half, 2 years, the properties have started, 2 units have been selling for 350, 400, 450. I mean, sky is the limit, right? What do you think happens in those markets, or even markets, you take some of the South Side markets, you touched on that earlier. What do you think happens?
Well, Berwyn's been a market that I've used as an example for months now, is right. When we talk about it, you see single family, the average housing stock in Berwyn is either going to be a 2-unit or a single family bungalow. The average square footage on a single family bungalow is 1,250, 3 bedrooms, 1 bath.
Right.
You can't turn that into a 4,000 square foot house. You might be able to get 1,800, but it is what it is, right? Berwyn, your school system is probably average at best, right? Do you have a downtown such as you have in Glen Ellen or Downers Grove or Clarendon Hills? No, right? So what's your major pushing point pushing those values higher and higher? There isn't one, right? So, but the property tax, Berwyn, I think, is going to see a 35% increase in property tax when those tax bills come up. You take a $7,000 tax and add 35% to that, you're at $10,000 on a $300,000 house. So, I mean, those markets, what's going to happen to them is that $450,000 renovated bungalow is going to come back to $350 where it should be.
Right.
You know, we're already adjusting where we're seeing our as-is stuff selling now at 175 to 200, which is fair. Where 6 months ago we were 225, 240. Right. So I mean, you're seeing that correction already, which it should be an as-is bungalow in Berwyn should be 150 to 200,000.
If you take a ratio of what somebody makes, right, even with the inflation, even with everything, what a family makes, average family in Berwyn, and you basically plot that out, the property prices were just ridiculous. Right? I mean, they were just absolutely ridiculous. And I mean, that's across the board. And it's going to take time for these property prices to start settling down.
You even saw it in Maywood.
Oh my God.
Maywood bungalows as is 150, 170. Where a year ago, they were, I mean, 3-4 years ago, the renovated value was 200.
Right.
So how's the as is 150?
Well, and these are frame bungalows.
Frame.
Right? Frame properties in Maywood, where you're going to have to do, I mean, 60, 70, 80 is just a start, right? In terms of rehab on those.
Well, you can't look at a house today with, I was talking to somebody on the way here, we were looking at notes. We were running through some numbers in the head. It was a 1,400 square foot ranch. I said, well, the repair budget's 100 grand. He said, well, maybe 120. You can't, if you think you're going to repair a house today for 60 grand, good luck. You're not, the costs are too high. I mean, windows, which were 400, now 1,000, you know. The cost of living, the cost of materials is expensive. So push your rehab numbers up.
Got it. So I guess the question becomes this, right? If people are looking for, because clearly there are price reductions happening big time, right? There are adjustments happening. Sellers that would have sold the property in 2 days, now they're sitting on the market, right? Where do you see it going?
We're seeing longer market times. To give you an idea, in August, week to week, MRED saw an average about 3,700 properties a week go under contract, right? September, that number dropped to 2,200 per week on average through MRED stats, right? Sure. So you're seeing longer market times, less properties go under contract. Is it seasonal? Is it the interest rates? It's a combination of both. Where do I see the market going? So you asked.
Yep.
I think it's going to correct. You know, they're going to lower rates a little bit today. I think they were at 7.2, though it should be under 7 by tomorrow or this week. If those rates continue to go up, the market's going to crash. I mean, you're going to see a big correction faster than we thought. If the rates stay at between 6 and 7, I think you'll see a slower correction. I think you'll see, you know, a 5 to 8% value adjustment. But if those rates get up to 10%, I think you're going to see a larger reduction in value, and you know, people are more anxious to sell.
Got it. So let's take, and this is something that would be interesting during the 3-day to talk to your buddies in the different markets, what they're seeing. How do you see our market different than, say, Florida, right? I mean, you have a place in Naples. Well, Naples is a very odd commodity, right? So let's forget about Naples for a second. But around Florida in general, right, there's a lot of people moving in. The market is very different, right, than here. How do you see a difference in those markets versus here?
Yeah, I think your Florida markets are going to, I don't think you're going to see a correction or a crash in Florida. You know, there's too much demand there. There's too many people that want to go there, and there's not enough housing stock. More people, you know, I read an article last week, Tampa's the new Silicon Valley. I mean, Tampa is going to be the tech bubble of the tech hub center of the country in the next couple of years. People are leaving California. People are leaving Illinois. People are leaving your high taxation states, and they're going to Florida, Texas, right? They're going to a place like that. So, you know, Salt Lake City, I think you're going to see that they're going to maintain. I think Texas, Florida is going to maintain, and I don't think you're going to see the same challenges you have here that you do in Florida.
Got it. Because I mean, if anybody looks at the net migration numbers, not migration numbers, net migration, meaning people who move out, people who move in, like that's your net. Florida has been the highest. I mean, it still doesn't make any sense to me, but if you look at the net numbers, it's just the highest, right? Doesn't have as many jobs as you think as Texas, but still, people with the storms and all, people love Florida for whatever reason, right? It is how it is. So in terms of what you're hearing, like when you're going to, say, some of these conferences, you know, REO conferences and all this stuff, that you attend, what is kind of the word on the street?
Foreclosures nationally are not. Nationally, we're not going to see a crash or a correction or a huge increase in foreclosures. Nationally, we have a lot of equity in homes. People bought right, and they have a lot of equity. However, Delaware, Illinois, New Jersey lead the list in the amount of foreclosures. For example, Illinois leads the highest foreclosure rate in the country is Illinois, with 1 in every 17 homes are in foreclosure. 1 out of 1,700, 1 out of every 1,700. You're not going to see those numbers in, you know, a lot of the western states or a lot of the southern states. You know, nationally, the outcome is people have equity in their homes. People are going to be able to, value's going to drop, but they have enough equity where they can sell and get out of it. You're not going to have that in New Jersey, Illinois, New York, Delaware, Maryland, Baltimore. We have challenges.
And one of the biggest factors, which is very unique to a market like Chicago, is what he talked about, and that's the taxes, right? I mean, you you take a market like south suburbs of Chicago, you have a property that's, you know, 1,200 square foot house, and you have one suburb where the taxes are $4,000 or $5,000. You have another suburb with taxes of $9,000, right? $9,000 on a 1,200 square foot ranch. It's, I mean, if that is not injustice, I'm not sure what is.
We had a property in Park Forest about a year ago. It's $52,000 in tax of $9,000 a year. You're gonna pay more in tax in 5 years than you'll pay for the house.
Yeah. I mean, it's obscene, and that's a lot of times people don't understand. Yesterday, this was the topic for the live that I did, that why is Chicago so unique and so obnoxious, right? Chicago is a very weird market. If you understand it, you can basically make hay. The problem is not a lot of people understand the Chicago market, because the devil with Chicago is in the details. I mean, you could go to Country Club Hills, you have a property next door at $5,000, another one next door at $9,000 with taxes, right?
15. I mean, a lot of homes in Country Club Hills. What happened in Country Club Hills? They built a lot of those McMansions in the early 2000s, and they were selling them for 550, 600,000, and that's what the county assessed the house at. So you have $15,000 tax. Well, that house today is worth 300,000
Right.
with a $15,000 tax bill. And they closed all the commercial. Well, they raised the tax on the commercial first. So the commercial left, which implicated if you drive down Harlem, down by 159th, and you get down in that area, all those car dealers are gone, right? So where's the money come from? And you're gonna see the same thing in Chicago, because if you look on Michigan Avenue, there's a 35% vacancy rate. Water towers went into foreclosure. So people don't think that the commercial affects them. Well, the county and the city have to make up that tax from somewhere, and it's gonna fall on the homeownership.
Right. And it's a lot of times, people will look at this, they're like, well, does that mean, oh my God, you can't buy properties in Chicago, right? Does that mean that you can't buy rental properties in Chicago? What's your take on it?
No, I think you can. I think you should. I just think you have to buy, like Sean said earlier, a pivot property, right? You have to buy smarts, and you have to know that you can cash flow on the property as a rental.
So explain what's a pivot property.
Sure, a pivot property, if you buy a house for 200,000, your intention is to buy the house, put 80 in it, I'm in it for 280, I'm gonna sell it for 350. Make a little return, I made some money. Well, if the market falls out from under you, can you rent that property for 2,200, pay your mortgage, and collect a cash flow of $400 or $500 a month? A pivot property is a property that I plan on selling, but if I don't sell it, I could turn it into rental and still cash flow. Today, in this market, I'm not one to suggest flipping, because we don't know where it's going. I think if you're going to buy a property today in this market, I think you look from, if you want to flip it, make sure you can rent it, because inflation is at 8.1%, right? 8.2, 8.3.
That's the official number.
In order for a market to truly correct, interest rates have to be higher than the amount of, you have to lend at a higher rate than inflationary rate, at about a point to a point and a half higher. So there's nothing saying rates aren't going to go to 9-10% within the next 6 months. So if they do, that property that you're going to flip for 350 now became worth 295, 275. Can I rent it? So I'd be very leery to, I'd buy everything thinking, okay, I want to flip it, but if I can't, can I rent it? Right. This mindset today.
Okay.
Or Airbnb.
Yeah, Airbnb is still, short-term rentals, but that's still a untested model, right? For the long term, it's an untested model. It works great when it works. If it doesn't, you're up the creek.
And to counter that is, if rates go to 10% and we had inflation at 8%, who's your primary person on an Airbnb rental? It's a vacationer, right? Excess money to live off of, right? Well, are people going to, in an inflationary market, they don't have a lot of liquid cash. Are they going to be going on as many vacations, right? So, it's, the long-term model, I think, is always safer.
Right. No, I mean, you don't have to convince us, right? We drink the long-term rental Kool-Aid, hook, line, and sinker. But the point of that is this, that if you're basically overpaying for a property, right? I'll give you a perfect example. Somebody called me, I'm not going to mention the person, but they called me. They're like, man, I have a property in Schaumburg, a ranch. They paid $310 for a ranch as one car garage ranch, right? No basement, right? What is it ranch? He's saying it's 1,200 square feet. I guarantee you it's no more than 950, right? He's like, dude, I made it beautiful. I'm like, okay, great. Good for you. Hope you plan on living in it, right? Because he has it on the market $495. And there's not a single person that'll walk through the property, right? He's like, well, man, the market is killing me. I'm like, no. The market has nothing to do with it. You overpaid for the bloody bastard when you bought it, right? He bought it in January, February, knowing that the rates are going through the roof. And guess what? He overpaid for it. And just because he's gotten away with 2 flips in the last 2 years, that he overbought, overimproved, and then got away with overpricing the properties. Guess what? This property, I don't want anybody that's a real estate investor to lose money, but he's going to get handed on this one, right? Because he's got a short-term bridge loan, and the bridge loan is coming due in December. and nobody's going to refund. I mean, you cannot pivot that property because you cannot get the kind of money he needs to be able to cash flow that thing.
I'll let you know what I sell for next year.
Yeah. It's interesting because this is something that you're seeing, that more and more properties, people are putting beautifully rehab properties, but they're in it for too much. At the end of the day, if you understand real estate 101, goes back to the basics, which is your buy price plus your rehab price. That's where the game is played. So, Dr. Ali.
Flip market, let's say 4 months from now. Let's say a flip market shifts towards the cash flow market. What do you think about the appraisal? Would there be lower appraisal?
Well,
So,
appraisal's gonna fall.
Let me repeat the question for everybody online. So what Dr. Ali was asking was that if the flip market converts to a rental market, right? Or you're forced to do the rentals, what happens to the value of appraisals?
Appraisals usually last 3 months, maybe 6 months of comps. So if the comps aren't there, the appraisal is going to come down with the market, right? Appraisals are a lot more stricter. You know, back in the day, they go a year back. Now they're 3 to 6 months max. So the market's changing the last 3 months, the appraisal is going to change. You're not going to get appraisal from 18 months ago. So the appraisal is going to change as well.
And that's the case for, or just talk about a property. We had a property in Chicago Heights. We bought it for, I believe, 55,000, 60,000. We maybe fixed it for 2022 and had it sold for 140. Appraisal comes back, I don't know, 115 or some ridiculous, yeah, whatever that stupid number was. And the only saving grace was our all-in price in that thing. We still made 15 or 20,000 bucks, but it's not, for us as a business, 15 or 20,000 bucks on a flip is just not worth it, right? It's not enough profit. There's not enough meat on the bone, but at least you could basically just say the appraisal came in short. What are you going to do? And every buyer, that's an FHA market. And you're going to sell the property 3 times, meaning the first buyer is going to come in. They're probably not going to qualify. They're going to fall through. And if that appraisal comes in, it'll stick with it.
The FHA market, FHA appraisal sticks with the property for six months. So if it appraises at 115, you could sell the house to the next 10 people for 150, whatever they want to put on the paper. It's not going to appraise out higher than 115.
Right. So, I mean, that's just, you have to take it and just run with it. What are you going to do? So, I mean, that's just the reality of the market.
I was reading an article the other day that rents, I think it was talking about Chicago proper, are starting to level off. I've been saying for years, I don't see how we keep sustaining these rents. Where do you see the rental?
So the question was, where do you see the rental market going, Chicago proper, or just in general? I mean,
Yeah, I don't focus as much on the rental market, I'll be honest with you. I think they've been high. I know they've been high, but look, as rates rise and taxes rise, unless people can buy, they're going to need to rent. So it's a supply and demand thing. While you don't think they can go higher, why not? If they can't buy the house, they can't qualify, they're going to have to pay rent. So I don't think you're going to see rents decline. If they level off, but they've been high, right? Yeah, that's a whole nother 3 day.
I mean, it's crazy, right? It's crazy because you take a basic market, you take a hillside market, Bellwood market, you have a property, barely 850, 900, 950 square feet, $2,000 rents, $2,200 in rent for 3-bedroom, 1 bath, and the bedroom's the size of people's closets. I mean, it's obscene. And the people who pay the highest rent ratio are always the poorest people. That's just a fact, right? The lower you are on the socioeconomic spectrum, the more you're being kicked where it hurts a lot. You know, I mean, just saying. I mean, it's fair, unfair, doesn't matter. Unfortunately, that is how it is.
You know, so it's funny you say, I went to a building on the south side the other day. From the streets, you're looking at the building, it's 6 units up. Every one of them's got a TV bigger than that.
Yeah.
Every single one
Of course. That's the whole, we won't get into the politics of that, right? So, Surya, you had a question. So the question was that we're obviously seeing the economy slow down, corporates laying off. That cycle has started. Everybody is feeling that pain and at a very fast pace. Does that affect the rentals, the foreclosures, all that kind of stuff?
Yeah, I mean, unemployment, they can't pay the bills. Yeah, it affects it, probably, yeah, it will affect it, right? How are they gonna stay in the house? How are they gonna keep up with the Joneses?
Yeah.
It will affect it. How will it affect the rental market? The people that get foreclosed on can't buy another house for 7 years, right? So they gotta, where are they gonna live, right? Housing is always gonna be a demand, right? Not everybody has to buy, and buying's a right, not a privilege, right? So people are always gonna have to rent regardless of the economy. So.
No, I mean, but definitely. I mean, I don't think it's a one factor that's going to pull the numbers down. It's going to be a host of factors all coming together. And when you have a market like Chicago, you're going to see pain. I mean, there's just no ifs, ands, or buts about it. You're going to see pain. I mean, if you're a real estate agent, grab some pom-poms, and I mean, you better be a pretty cheerleader, jump up and down as to how this is a wonderful time to buy, because unless it's a great time for shrewd investors, right? I mean, this is just what it is. You got to be extremely shrewd and you got to be extremely on the ball, because otherwise the market will hand it to you. I mean, that just, gone are the days of last 2 years where new people get in real estate, $100,000 home runs. I mean, that was not realistic to begin with. And I mean, that's gone. So. Any other questions, guys?
I don't look at it. I'm not sure. I don't know what their process is. I don't study their process in Florida. No, yeah, like I said, I focus on here, and I'm sure, I don't know how they do it in Florida. I'm not sure. I mean, they have foreclosures down there. I know on the East Coast they have them. Miami-Dade is a huge foreclosure market. It's a huge county for it. But I couldn't speak on it because I don't know it. I don't know their process or anything of their numbers, anything like that.
Okay. Any questions, Lori? Oh, okay. Okay. No, he was asking about foreclosures in the Florida market. I mean, if you pull the list of foreclosures in the Florida market, it's a joke, right? I mean, it's a joke in Texas. It's a joke in Florida because, I mean, there's really barely any inventory. There's short sales, right? There are short sales that are showing up in the Florida market. There are short sales that are showing up in a bunch of markets. I mean, there are 9,000 short sales right now in the Chicago market. How many of them make it to sale? That's yet to be seen. But clearly, there's a lot of short sales, right? At one time, just to give people relativity of this, at one time, you had 90,000 short sales, right? But then you had a month during 2008, 9, 10, 11. I mean, how many properties went to foreclosure a month at that time?
God. I mean, probably a month. You're probably seeing 1,500.
1,500 a month. Yeah. It was 100, 150 a day, right? 100 to 150 a day in the Chicago counties. And this was every day, right? So clearly, we're on a different side of it, but definitely it's going to become a lot more strategic in terms of investing, right? Because all the factors are stacked against the normal investor is going to have a hard time. So the question was, is veteran housing?
What do you mean by like buying with VA loans?
No, for veterans. So basically you have a Veterans Administration that gives you a certain amount of payments, guarantees the payments. Man, listen, a lot of times, this would not be right. This would not be, if I had a real estate license still, right? I put it on ice. I don't give a damn, right? So I can say whatever the fuck I want, right? No, because, as a real estate agent, you have ethics, morals. Well, I can speak the truth, right? Half the shit in Southside people own would not exist if it wasn't for Section 8, Chicago housing, and veterans housing. So what I'm trying to say is that it's a great option depending on where you are, right? If you have good quality properties, it'll work. But I mean, I've said this many, many times, and it stands and it's showing up today. You go to places like Harvey, you go to places like Posen, you go to some of the challenging places, you go to Forest Park and Park Forest. I mean, you're going to have problems. And the reason you're going to have problems is that in some of those markets, the Section 8 housing or housing choice voucher, whatever they call it, they were paying $1,800, $2,000, $2,300 on those properties that you could buy for $50,000, right? I mean, it was just crazy. It's just obscenely crazy. But now it's coming down on the back end of it because a lot of those property prices are dropping like no tomorrow, and people are going to have issues. So, but if you're buying good, stable areas, you're fine. So.
Okay, so there's some questions online now that are coming
Okay.
through. With interest rates as high as they are, for flips, who's the average buyer pool now?
I don't think the buyer pool, I mean, you're going after the same buyer. It's just their affordability changes. You know, and it depends on where you're flipping it. If you're flipping in a $200,000, $400,000 price point, it's going to be a first-time home buyer. If you're flipping in the $1 million market, then it's a move-up buyer. I don't think your buyer pool changes, their affordability changes. So your budget changes and what you can get on the back end change, but your buyer is going to stay the same. I mean, your home buyer is a home buyer, right?
Next question is, what is the best approach to calculate an ARV in the next 3 to 6 months, since we might be in a downturn market? Do we do current ARV minus 10%?
Yeah, I think you do mine it. I mean, when I look at values now, I think you build in a cushion. I mean, when we underwrite stuff that we look at on the note side or things like that, yeah, we build in a 5 to 10% cushion. We looked at a portfolio in July. And at the time I took my as-is numbers and renovate numbers, and I did 8% less because we were going to acquire it in August, go through deed and probably have it in January. So yeah, I'd say 5, 8, 10%, 10% to be more conservative. Yeah.
Question is so what's the process of purchasing a home from an REO agent?
Oh, that's a great question. It's a basic question, but I'm glad we didn't touch on that. So no, we skipped right over that whole thing. So
I know Ryan loves this question.
Yeah, I mean, you can send me an email, we'll get you on our database, and then if something comes up, we'll be happy to help you that way. But if you're talking about actually buying it, when you find the house you like, it's have your ducks in a row, right? Have your proof of funds, have your pre-approval. If you're an LLC, have your LLC. Look at the house. Look at the house. Look at the house. Look at the house.
what do you mean look at the house? Because people don't understand what you're talking
We get a lot of blind offers, or people, or my favorite is, look, I bought 100 homes. I know what I'm doing here. All right, well, you don't know if the house has a foundation crack. You don't know if the roof's bad. Like, well, I've already worked in my repair budget. Just go look at the house. If you're willing to spend $200,000-$300,000, take the hour out of your day and go look at the house, right? The guys won't buy a pair of jeans for $200 without going to try them on, but you're going to spend $300,000. I'm an expert. I mean, you could be an expert, but take the time to go look at the house, because 90% of the people that say, I don't need to look at it, once they get under contract and they go look at it, they cancel the deal. So if you're not going to look at it, I'm going to ask you to make earnest money non-refundable up front. I'm going to ask you for 10, 15%. And then all of a sudden, you're going to change your mind, right? Even Andrew's bought thousands of homes, hundreds. I mean, he's bought hundreds of homes for me. If I call him, he said, what's Lockbox Square? I'm going to go look at it. He goes and looks at it. So why wouldn't you go look at it, right? Take your time, look at the house. Please look at the house.
So what's been going on is there's a lot of people that'll put in blind offers, right? And then go and just understand, guys, this is a business. Like for him, he's got to move assets for a institution, right? If he just basically lets you, because you're some guru somewhere and you're the damn expert, right? Just because you buy 4 houses a year and you supposedly made $200,000, that does not make you an expert. Just please. Right. And nobody here is an expert. We're all learning this process, right? This is just a growth process for all of us. But what happens is this: you go make an offer, you're like all confident, you feel great, you show up there are factors. We've all shown up to the house, which we thought was great. You get there, like, shit, man, I didn't think about this. And then you send them an offer, they send it forward, they get their lender, I mean, they get their asset manager to sign it. And then you're going to make him look like an idiot. This is a credibility business, right? Just so understand, nobody's trying to basically question your knowledge. But what the issue here is that you got to be credible. Like when you say something, people have got to believe you, and you can't just say, well, what's the big deal, right? No, it is a big deal because it's time, effort, money, people's reputations are on the line, right? It is a big deal when that's what makes you a living and you got to do 30, 40, 50 deals with that same bank. Then it is a big deal.
And another thing is that bothers me the most is people say, well, I looked at the pictures 100 times. I'll tell you a secret. We hire a professional photography company to make those pictures look a little bit better than they actually look in the house.
Right. So it's basically what
So-
he's saying is, right? A donkey will look like a thoroughbred horse by the time they're done with it. So that's the
I
job.
mean, we want to draw people to the house. We want to say, oh, we want 50 people to go look at the house, right? And don't look at just go look at the house.
Right.
That's it.
So-
And another thing when you're buying an REO property, probably one of my biggest pet peeves. Go look at the house. Great. Okay. I have my repair, but I'll buy it all day long. Don't have the mindset of I can buy it and renegotiate after I go on contract. It's like you said, you're wasting time. Like, don't think you can, because I'd rather sell it to somebody else than even give you the benefit, even if it's a little reduction. Well, the plumbing's not working. Well, it wasn't on when you saw the house. You know, I'd rather off principle say I'm not. And yeah,
And guys, here's the thing, right? You go to a house that's been abandoned 3-4 years, right? I mean, people are, well, I don't know what I'm going to find behind the walls. What the hell do you think you're going to find? Right? I mean, what are you going to find? You think pot of gold there's going to be? I mean, it's busted pipes, right? And if it's really bad, you're going to have to change basically not only the, your lines coming in, you're going to have to change the vent pipes. You're going to have to change the, line going out. You may have to change the line coming into the damn house. I mean, it's not like, well, I don't know what I'm going to find.
Yeah.
I mean, what the hell do you think you're going to find in the house?
and like another couple misconceptions. Broken pipes is not as bad. Like I can fix a whole house of broken pipes as long as I'm not changing the sewer and the main line coming in for $5,000 to $6,000. Right? I mean, the whole house can have 50 breaks. Right? I'm at $100, $250 a break. Right? To fix it, it's not a big, and mold's not a big expense either. Don't think mold's 40,000 to remediate. You can remediate a whole house of mold for, a whole house, floor to ceiling for 12 grand, and have a clean air test. Mold's not a big deal. Broken pipes aren't a big deal.
No, but I mean, you got to know what you're doing though.
Right.
So, because this is something that comes up all the time where people will go in and it's the obvious that is expected for you to know that, hey, there may be busted pipes, there may be broken pipes, you may have to change the plumbing out. It is what it is, right? What are legitimate things? If there's something really legitimate where you guys are like, no, this is fair, man.
Yeah, major structural issues, foundation cracks, settling of the house, right? Like, okay, that's fair. If the basement walls bulging out, you got a bowl in the basement wall, major cracks, major water issues in the basement, fine. Rotting of roof trusses, termites, major things that you can't see from the eye, right? Rotted window trim, no, you can see that, right? Broken furnace, broken out water heater, broken pipes, a bad roof. When I say a bad roof, means shingle replacement, a tear off. You should be able to see that from the eye.
Right.
But if you get in there and all the rotted wood in the attic space is rotted out, okay, that's legitimate. If the basement's major structural issues, legitimate. Settlement, things of that are major causes, okay, we can look at that. But a broken
That
furnace.
you guys are not aware of and has not been accounted for.
Right. And as is means as, we sell all of our properties as is, it means as is. So if you walk in the house and the plumbing's off, the heat's off, assume the worst, it doesn't work, right?
Yeah.
Don't say, well, I did my inspection, the furnace didn't work. Did it work when you walked in there? No.
No.
Well, it didn't work now. So, don't ask for $7,000 credit for that because you should know better. Right.
And this is something that people will ask. I mean, this is, again, well, can you guys turn on utilities?
Yeah, look, we'll try. We'll turn on gas, heat, and we'll try to de-winterize the house. We will. But if the pressure didn't hold, and pressure not holding can be from a very small, one of the valves is busted. Well, pressure didn't hold. That doesn't mean the whole system's broken. If pressure doesn't hold, we're not going to turn the water. It's as is. Figure it out.
So, Shantanu.
You shouldn't waive the inspection.
So hold on. So Shantanu's question was, and I know where this is coming from,
Yes,
right? So Shantanu's question was, well, what if you waived the inspection, right? Meaning you said, hey, waive the inspection, I'm going to buy the property as is.
Go look at the house and make sure you're waiving the inspection.
And
'Cause
then
what-
I find problems.
Go make sure you look at it. If you find the problems after you have a signed contract where you waived inspection, made earnest money non-refundable, you sign that contract that you waived earnest money, made earnest money non-refundable. That earnest money is the seller's earnest money. Your inspection period is done. You waived it. If you went to look at the house after you went under contract, you did that on your own. The seller doesn't have to recognize that because you waived it. You made earnest money non-refundable. I hope you looked at the house before you did that. Because the seller's gonna say, this contract that we both signed, you put 0 inspection days, earnest money non-refundable. Why are you doing an inspection? For my own knowledge, that's for your own knowledge. So let me ask you a question, too. Let me ask you a question. You go under contract on a house for 300,000. The bank signs the deal. You go under contract, you do the inspection, you have no issues. You say, hey, there's no issues. There's no issues. Raise that to 320. Are you gonna pay them 320? Why? There were no issues. Why not raise the price? You're getting it for a deal. Oh, I know. Believe me. Believe me, I know. The point of that is if you're going to waive the inspection, you're going under a contract. The bank expects you to perform just like you expect the bank to perform. You don't want them raising the price. You said, I'll take this with no inspection. You signed that. So I said, look at the house for it. So you know what you're walking into. So that's all. I mean, if you're going to waive your inspection, know that you're waiving it and be confident that. That's why I say, go look at the house again. Make sure you know what you're doing. Because if the two people sign a contract, it's bilateral, right? You both agree to that. For 21 days, yes.
No, because otherwise there's no point of a contract, right? Because
Yeah.
if neither party is going to hold up to it, there's just no point to it, right? If you're just going to do whatever the hell you want, then the bank basically, you make an offer, they accepted 300,000, I come behind it, and I'm like, the hell with his offer, I'm going to pay 320. Should they kill your offer?
And that happens a lot of times. That happens a
Hold on.
lot. I go on a contract. It happens all the time. I'll be on a contract and somebody will come in and say, well, I'll offer from 350. Go kill that up. I have a contract. I'm not going to kill that offer. That contract you signed, it's liable. It's standing, right? So if you waive inspection, and another point is if you didn't have that, everybody would be doing that. We would never sell a house. Because I'd bounce from you to her, to her, to her, to him, to him. I said, well, no, I don't want to. I'm changing my mind. There has to be some type of recourse, right? Just like there has to be foreclosures in the market. If there were no foreclosures, who would pay their mortgage? If there was no earnest money, who would buy the house? You know what I'm saying? There has to be recourse to the contract you sign.
Anybody else?
Is it common for people to, have a real company to wait?
It happens more often than not, yeah.
So is it common for people to go waive the inspection, not even view the property?
It happens more often than, it happens more than you think it should. That's why I harp on it and push back on it, because people will say, well, I flip 50 hours. I know what it needs. Go make sure you know what it needs.
Hey, Andrew, you could pull up my property and look at the pictures. The one about the REO.
Yeah.
Yeah, and you could tell why you should go look at a property.
Oh, yeah. This is
Is that the one on 1220 Emerald?
Yeah,
that was one of your,
1220 Emerald.
that
Yeah.
was one of your listings.
Yeah, on the west side of the street. Brick.
Right. And I was telling, I was like, Lori, are you sure? Oh, yeah, I'm sure. This is last February, right?
Yeah,
What's the,
1220 Emerald. I remember every listing.
is it not connected, Lori?
No, I know the house on the west side of the street. Brick 2, harbor floors, garage in the back. It wasn't a great garage, but it was a garage.
It was a garage, yeah. 1220 Emerald. Why the hell is this not working? Huh? Oh, here we go. Yeah, this is actually a great example of a property. So this is, yeah, no, this, if you guys look at the inside, look at this. Right? Looks like a pretty decent condition, actually. Right? It kind of, you look at this picture, it looks like old world charm. You know, it becomes very charming when you pay
Great
for it.
photographer.
But no, I mean, you know, the only place you can really see is you're like, oh, this is not bad. All I have to do is just touch up the ceilings, right? Paint it, right? The back stairs looks pretty good. The upstairs looks even nicer. So Lori bought this property. This was one of your listings, right, Ryan? And then Lori, you bought it for 90, 95, and then you dumped another
200.
No. Lori would not have a job for sure. 70, 75. Yeah. Yeah, 70, 75 into it. And she just got appraisal back for 240. Right. So
There's value in REOs.
there's value in REOs, right? That's why we have you here. So, huh? Yeah, even sight unseen, right? So, yeah. So having said that, guys, hopefully this has been informative for everybody. If you're watching online, if you haven't, Lori will put the information for the 3-day because it's literally around the corner, as we say, which is on the 18th, 19th, and 20th. And I think as of tomorrow morning, so tonight, 12 o'clock. Oh, tomorrow, 12 o'clock. So tomorrow at night, 12 o'clock is when the prices go up because this is the final week. So the prices go up for the 3-day. For those of you guys don't know, you can attend it online. But if you can be there in person, there's a lot of value because we have lots of people, experts like Ryan, be there. There'll be the King of Southside. You got to tell him he's got to be there.
Yeah.
Huh? Oh, the King of Southside is going to be there. And we'll have lots of fun. It's right here down the street at the Hilton, right? At the Hilton in Oak Brook. If you have a spouse or a friend that you want to bring, this time there's a huge focus on how do you adjust for the changing market? Because if you're not adjusting for changing market, you're going to miss out, period, right? And that means you're going to lose a lot of money. Yet every time there's a market shift is where you build wealth, is where you make money, right? Whenever everything is going great, that's where the challenges come from because then people overpay. So we're super thrilled, we're super excited because this is number 26, I believe. I'm sorry, 25. Okay. Oh, so the 25th anniversary. So okay, great. I thought it was 26. So this will be good. So look forward to seeing everybody. Again, register. She'll put it in the chat box below if you're watching online. For everybody that showed up here, thank you very much, Ryan, as always.
Thank you.
Thank you, Ms. Koya Smith at the back of the room. Thank you very much. She's always, shy and she hides, but the product turned out pretty good, right? So thank you so much. All right, guys, thanks a bunch and have a good day.